Simon Derrick. He's the chief currency strategist at Bank of New York Mellon. A quote from you, sir. There is an increasing possibility that this summer could see one of the most significant events in the currency markets since the Nixon shock of 1971. Explain. That, of course, ended the convertibility between the US and gold.
Absolutely. And no, I think the key point here is I'm talking about a pure currency market event. There's obviously been other huge market events in there, but they weren't purely currency. We're now talking about something where we're actually taking an individual currency and there is at least the possibility that one of the constituent parts of that currency could break off. Now, we've had plenty of times when we've seen pegs broken over the course of the last 30 or 40 years, plenty of times when we've seen exchange rate mechanisms pulled apart. But for the idea that a currency could actually lose a constituent part, even the possibility, seems to me the largest shock since we went to free floating exchange rates.
So, predictions from you. We're under 125 to the dollar at the moment as far as the euro is concerned. 2 months, 6 months. What are you thinking of?
I think that we're going to see the weakness building relatively quickly here, and I'm talking not necessarily the next 2 weeks, but over the next couple of months. I think we're starting a good chance of getting down towards 117. How it plays out from there is obviously dependent on events of the summer, but on the assumption that there will be some kind of response by the central banks, I think if we're talking about 6 months' time, maybe we see the euro start to come back a little bit, low to mid 120s.
Now, we'll get a little bit more on this, but I'm fascinated by your take on China and China's relationship holding up the euro, maybe at 132 for a long time before we hit these levels, when Greece was going through all the turmoil. And you're putting forward the scenario that when China has large reserves, it wants to diversify, and it starts diversifying into euro. And that's what held the support. Now, very interesting to see what the reserves will be for May.
Yes.
What do you think? Is China thinking, hey, let's go somewhere else now, like a lot of other people are?
I think actually May's a fascinating month because what has clearly happened is that China is slowing down, and not just China. The other emerging market nations are clearly on the back foot as well. So the likelihood is that over the course of May, reserve growth throughout the world has probably gone to somewhere close to zero. If that's true, the need for these guys to diversify reserves simply disappears. And therefore, the demand for the euro that kept the currency so well supported in January and February still isn't there. So if you believe it is going to be one of those summers where we're on the back foot with regard to risk, where you aren't getting the flows into China, where you aren't getting the flows into other emerging markets, I think actually that is the thing that allows the euro to really take the fall.
And there's a follow-on from that, because if you look at the oil price, which is continuing to decline, so the big countries like Saudi Arabia, who also might want to divest some of its foreign exchanges into euros, maybe saying, well, we're not getting as much money in, we don't need to do that. What does that mean for the euro?
And I think exactly right. Again, you go back to January and February, what did we have? High oil price, the need for the oil producers to diversify, the euro's higher. Now the oil price is coming right off. Again, the euro's weakening.
If China's not going to do a lot of stimulus, what about other central banks? That's a key question that guys like you are asking right now.
Absolutely, and I do think that at the moment the Western central banks, at least, along with obviously Japan and obviously with China as well, are pondering quite what they do on the policy stimulus side. We've had 3 years now of QE in one form or another, or various different policy measures, and yet we've still got the same problems. I've also got a feeling that the central banks globally, particularly in the US and the UK and the Eurozone, are sitting there, and again, they're worrying about the fallout possibly from a potential Eurozone crisis. And they recognise that they may have to take further measures perhaps 2-3 months down the line. I suspect that actually what they're doing right at the moment is keeping the powder dry a little bit. Rather than going too early, they need to have something to be able to respond with.
Well, clearly the dollar's been the beneficiary as that safer haven, but also interestingly as well, the Japanese yen, it's up, what, 5% since mid-March. Anything the Bank of Japan seems to do always seems to be a little half-hearted. The government really doesn't seem to push it either. What's your take about where the yen's going and what the Japanese should be doing?
I think that they're caught between a rock and a hard place at the moment, and I think it's very simply this. Over the course of the last decade, there's been so much Japanese money flowed into overseas markets that any time that you actually see any kind of crisis build, there's naturally money coming back home. Right now, for them to try and fight against that natural caution, I think is extremely difficult. The best thing they can do, I think, is to stabilise it somewhere a bit above the historic lows we saw on dollar yen late last year, early this year. I don't think for the moment they're going to be able to weaken the yen.
We shall see what happens. They've had a great deal of success so far. Simon Derrick, Chief Currency Strategist at Bank of New York Mellon. Always a pleasure, sir. Thanks very much indeed.